Welcome back, friends. So, last week was a particularly difficult one for Jay Powell. The Fed chair had to encounter another round of criticism from President Trump, who described him as a stupid person. On Wednesday, the US media reported that a president might nominate a new chair well before Powell's term expires in May of 2026. The president's eyes seem to be centered on May of 26. White House later said that no announcements were imminent, helping to quash a sell-off in the US dollar. The rumors around his job rounded off a week that had started with other members of the Fed's rate set cutting pushing for cuts as well. If Trump wants rate cuts, then his interventions and chaotic policy agenda are unfortunately not helping his cause. Let me explain. For starters, should the president reveal his successor to Powell well before his term elapses, then it raises the worrying prospect of a shadow Fed chair who would signal a more dovish direction on rate from the sidelines. That would stoke confusion in the markets and distort the transmission of the monetary policy. Right now, it is also driving speculation of a loosening in the future policy stance, as recent market moves have shown that weakens the dollar and it boosts the case for higher interest rates at the margin. Then there is the immediate uncertainty around the president's tariff policies. At its meeting in mid-June, the Fed held rates at 4.25 to 4.5%, but its policymakers were split on where they should go next. Recently, two rate setters, including Christopher Waller, a leading candidate to succeed Jay Powell, said that the Fed ought to consider cuts as soon as next month. After all, there has been only a slight uptick in US inflation readings since the president's April 2 tariff announcements. High rates are constraining growth. Credit card delinquencies are at their highest in over a decade, and annual wage growth on job postings are at their joint lowest in 4 years. But Jay Powell's caution is sensible. At least that's what it appears to the investor community. Data on Friday showed that in May, annual growth in the core personal consumption expenditures index, or PCI as it is popularly called, the Fed's preferred measure of inflation, rose to 2.7%. Indeed, it is too early to judge the effects of tariffs on inflation. First, the US businesses are still working through imported stockpiles. Price pressures from existing tariffs may not show up in the inflation numbers until the summer months. I would say something like mid-August you may start seeing good effect of the tariff numbers. The Fed would then be in a better position to understand how higher duties are passing through supply chains and how much of it is getting passed on to the consumers. Second, Trump's full tariff package hasn't even hit yet. It is unclear what duties will prevail beyond July 9, when the president's deadline for trade partners to renegotiate his Liberation Day tariffs expires. When those levies take effect, they will push up prices even further. The administration is also mulling additional sector-based tariffs. Other price pressures may build too. Global oil prices remain exposed to the fragile ceasefire between Israel and Iran. Trump's tax-cutting Big Beautiful Bill could add further price pressures. If tariffs, the pass-through to consumers and the broader price shock surprise to the upside, then there is a risk of a sustained rise in inflation, not just a one-off jump in the price level. After all, Americans have experienced above target price growth for about 4 years, and year ahead inflation expectations remain elevated. But if the implementation of tariffs are delayed and uncertainty lingers, then the demand may drop faster, and thereby that raises the case for cuts. For now, keeping rates on hold feels like the safest option given all the uncertainty that surrounds it. But that means that the risk of a policy mistake is high. If the central bank had more clarity on the extent and the timing of the tariffs and the president's broader agenda, then it would be in a far better position to ascertain the risk of cutting rates sooner. The president would therefore realize the dilemma that the Fed is facing, and we do understand the president's dilemma as well. The lower the interest rates, the lower would be the interest cost of servicing the debt burden that United States faces, and that would therefore reduce the size of the budget deficit. The smaller the size of the budget deficit, the greater strength of the US economy, and therefore its credit rating would remain high. A decent credit rating would ensure that the cost of borrowing in the future would be low. All this augurs well for reducing the costs to the borrower, to the consumer. Lower costs of borrowing for businesses can lead to reduction in the cost of doing business and improving the bottom line. As the bottom line improves, you would find that earnings increase. As the earnings increase, you will find that even with the same PE ratio, you will find that the stock prices going upwards rather than lower. And in this scenario, you would find that the shareholders, the stock markets benefit, and there would be a wealth pass-through effect that would eventually augur well for the US consumers, for the United States in general. So lower interest rates would be helpful. President Trump has talked of appointing somebody who would go and reduce interest rates at the earliest. Now, that is something which is very difficult to reckon in this scenario. At the same time, one would like that the uncertainty surrounding the appointment of Jay Powell's successor, the earlier this uncertainty comes to an end, the better it will be for the US financial markets and thus global financial markets. So I hope that all these factors, beginning with the big, beautiful bill, they all come to fruition and they come to a quick conclusion at the earliest. I believe the next few months will lay the seeds of what is going to happen over the next few years and are extremely vital and crucial in this regard. Let us unravel and tell you where the US markets are headed. Do join our Prime Plus Telegram group, which are specifically addressed for the US markets, and give you our forecasts and predictions on a weekly, daily and monthly basis. You can join them by WhatsApping us on 732-732-2720. Happy investing. Take care. Bye-bye.